This is how much you can save when buying a house by simply talking to a few brokers instead of committing to the first one you meet. I didn't know this in many other lessons when my husband and I were buying a home for the first time a couple of years ago. So I thought that in this video it would be helpful to share the lessons we learned during the process so that you can feel more prepared when buying your first house. Lesson number 1 is to interview a few potential agents and brokers. Your mortgage broker and your agent are the two most important people in your home buying process. When interviewing your brokers, ask what rates they offer. Your goal is to find one that has access to the most competitive rates. Here's the example of how much interest you can save by getting a rate that's 1% less. And this is the difference it makes on the monthly basis. Once your offer is accepted, you'll need to get the loan within less than 30 days. So you need a broker who is reliable and communicates well. Best if they can give you a list of things you'll need in advance so that you're not left scrambling at the last minute. Your broker should have a track record of closing loans on time. When interviewing for your agent, look for one who has worked in the area for a while, someone with great negotiation skills. This may mean that they're able to build a positive relationship with the seller's agent, find out if there's anything in particular that can help set your offer apart, like ability for the seller to rent back after the sale, or expedited closing period, or any other circumstances your seller may have. And look for an agent who will not get frustrated if the process is taking you a while. Buying your first home is a big deal and can take 2 weeks or 2 years to find the right one. My last tip is to introduce your broker and your agent so that they can communicate as well if needed during the process. Next lesson is to prepare the paper trail. To make sure that your down payment money is legitimate, your lender will ask for paper trail for your funds. This will be in compliance with the Patriot Act and FHA regulations if you're getting an FHA loan. For most people, down payment will come from a few sources. So if that's your case, make sure that you have bank account statements, gift letters, and access to transaction and transfer history to show where the money came from. Talk about this with your lender in advance so that you know how far back these need to go. Our lender asked us to go back 5 years, but I think that's on the longer side. By the way, if you're not sure how much down payment you need, I have a video where I break down and rate options of going with a low 3% down payment, a 10%, and a 20%. Going with the largest down payment is not always the best option, so be sure to check it out. I'll link it here and down below in the comments. Lesson number 3 is to have additional 2 to 5% of your property costs set aside to cover closing costs. Your closing costs are your loan fees, your home appraisal and inspections. Your agent can likely help you find an inspector and appraiser and give you an idea of how much that will cost. You'll be paying for title insurance, escrow fees, and any additional inspections you choose to have. You might want to check for lead, mold, and look into any issues that come up during the home inspections. And after you're done with these, if you're going into an HOA, there may be an initial lump sum payment required. You'll be looking at moving costs, cleaning costs. If something breaks when you move in, which for some reason it happens all the time, you may need money set aside for that. You'll have to get your utilities set up and pay any deposits if required. So general rule of thumb is to have 2 to 5% separate money to help with these closing costs. Lesson number 4 is to plan for taxes. Your property taxes are set at your state and local level, so these will be different for everyone. US national average is just over 1%. Your taxes will be included in your monthly payment, so there shouldn't be any surprises. But here are a couple things to consider so that you're not surprised with a hefty bill like we were. There is a gap tax and a prorated tax. Let's say your seller bought a home 10 years ago for $200,000 and was paying taxes on that amount. They sold you the house for $600,000 and now your tax is calculated based on the $600,000 amount. Some states and some counties will charge you this gap tax shortly after you settle in, usually in the next year or so. Before paying that bill, be sure to contact your lender and see if they can pay it for you. This would mean that at some point in the next year, your monthly mortgage payment will go up because you'll need to backfill for the cost to your escrow account. There's also a prorated tax. Depending on the month of your purchase, you'll be responsible paying the prorated tax for the part of the year that you are the owner, and that's typically included as part of your closing costs. Lesson number 5 is your bills will be higher. If you're moving to improve your living situation, that may be a bigger house or a bigger yard or a pool, your bills will likely go up. Here are some of the examples of the bills that may come up when you're moving from a condo to a house. You can't anticipate everything, so I wouldn't spend too much energy trying to find out what the previous owner paid. Instead, I recommend that when you're figuring out how much monthly payment you want to afford, build in some buffer so that you are not stretched too thin paying all the bills. This brings me to my next lesson, number 6, buy less house than you can afford. General rule of thumb is that your housing expense is less than 30% of your take-home pay. So if you make $10,000 a year, after taxes, that's $7,500. 30% of that is $2,276. I would look to have 90% of that go towards your monthly mortgage payment and leave $276 for contingency in your payment budget for higher bills or annual property tax increases. Lesson number 7 is to read everything, especially HOA minutes. During the process of buying a home, you'll have a million things to read and sign. It can get really overwhelming, but if you know that ahead of time, you can manage the situation better. Reading through these documents can potentially save you thousands of dollars and avoid any issues with the property or the loan. One of the properties my husband and I attempted to buy had a pretty high HOA fee, and the seller provided us with the HOA minutes to review. In the minutes, we found that HOA reserves were under 30%, and the building had major underground parking garage repairs coming up due to some tree roots getting through the cement and ruining the foundation. The HOA that was managing the building did not have enough in reserves to cover that repair. So we learned that when that happens, HOA issues a special assessment that each resident is expected to pay in cash. Looking through the documentation, we saw these special assessments as large as $10,000 to address unbudgeted repairs. This issue alone was enough for us to stop from moving forward, and we decided to continue renting and look for another property and not take on this huge financial risk. If you're buying a place with HOA, here are some things to look for when reading through HOA notes. Look for a summary of upcoming repairs. Look for how much is in the HOA reserves. Best practice is to have 70 to 100% in reserves to cover upcoming repairs for the next 5 years. Look for past assessments, how large and how often they were collected, and see any mention of future assessment. Lesson number 8 is that if you make a homeowner's insurance claim, your monthly mortgage payment will go up. Your monthly payment consists of principal, interest, and escrow. Your property taxes, insurance premium, and private mortgage insurance are all paid out of your escrow account. Your lender will be paying those bills once or twice a year on your behalf, and you'll be putting money into your escrow account held by your lender to cover these costs. Let's say your pipe started leaking and the moisture destroyed the cabinet panel under it, so you need to fix the pipe and replace the cabinet. This is definitely something that can be covered by insurance, and they can review and provide you with the payment. The cost of that is not very significant compared to some larger issues that may come up that you won't be able to cover out of pocket. So the important thing to know is that each claim, no matter how small, makes your insurance premium go up and can have a negative impact on your risk profile. When insurance premium goes up, since it's paid out of your escrow, this means that your monthly payment will be permanently increased. So keep in mind that insurance is definitely an option, but use it wisely for big things if and when they happen. Lesson number 9 is not to try and time the market. When the interest rates are low, real estate prices go up. Combined with multiple offers, they get even higher. You'll be financing at a lower rate, but the amount you're financing is going to be higher. In reverse, when the interest rates are high, property prices go down and you'll be financing a smaller amount but at a higher rate. Just like with the stock market, trying to time the real estate market is a losing game. Instead, focus on finding the right house for your needs when you're ready to buy. The decision to purchase a home is deeply personal and often tied to lifestyle changes, whether you're starting a family, moving to a new state, or simply wanting more space. It's about finding a place that aligns with your life goals and priorities first, with the investment aspect of it being secondary. Real estate is a big commitment, so the timing should be based on your readiness, not market speculation. Owning a home is often seen as an investment because it can appreciate over time, but it's not always the best choice compared to other investment options. For one, the real estate market can be unpredictable. Home values don't always go up. Economic downturns, rising interest rate, or changes in local demand can cause prices to stagnate or even drop. Another challenge is lack of diversification. When you buy a house, you're putting a huge portion of your money into a single asset. Unlike investing in a diversified portfolio of stocks or funds, investments where your risk is spread across multiple areas. Real estate leaves you vulnerable to what happens in that one market. It's a lot of eggs in one basket, which can be risky if things don't go as planned. Total cost of ownership can be much higher than your new mortgage payment. Over time, the additional expenses can add up to thousands of dollars annually, making the true cost of ownership much greater than what you initially budget for. That's why it's really important to factor in these costs to avoid surprises and ensure that your home remains a financial asset and not a burden. Now, here are your rapid fire home owning notes. If you plan to fix up your new home, you should know that every project will cost more and take longer. Consider getting quotes for a project before starting doing something on your own. This may help you avoid a prolonged construction zone in your house and may help you save some money. When you estimate something in your head, let's say you want to redo your kitchen or put in new flooring, double or triple that personal estimate. We usually grossly underestimate how much things cost in our head before we talk to a contractor. And here's my biggest advice. Every time you consider hiring for a project, big or small, get multiple quotes. Get 3 to 5. This can save you thousands of dollars. And do these quotes on your own terms. I once had a contractor ask that my husband is there when I talk to them about a project. And another one who requested 2 hours of my time to give me an estimate of how much it would cost to put down a square of sod in my backyard. Don't fall for these traps. Don't be afraid to ask questions and don't be afraid to set your own rules. Thank you so much for watching. I'll see you next week.